So now let's come to some statistical study. Every week we do one session where we want to study some data backed statistics. So will Nifty explode in the next 2 years is the question. So we've had some plenty of volatile phases in Nifty's journey. This is the last 5 year chart where we've had, explosive growth, then a consolidatory phase, then explosive growth, and perhaps we are right now in some consolidatory phase going forward. Yeah, earlier than that, we've had periods in financial 15 to 17 where we were chopping around, and then of course 18 to 20 was also reasonably challenging. Prior to that, we had the GFC crisis where for almost for 4 to 6 years, Nifty did not make a new high. 15 to April 17 also was this challenge year, and somewhat this entire uh, period of this should have been 04. An entire decade was spent, in this range of perhaps 800 to 1200 mostly, and then there was one sort of dot-com boom in the middle. So we all know very well that long-term trend has been upwards despite small opticals in the middle. But if we see the long-term picture, what you will notice is that there has not been any red year, any red candle for the ninth year running. So this is just amazing that you earlier at least had few down years, but now at from year to year basis you are seeing only up years. Hardly any obstacles are there. So, what has happened during this correction, Nifty and its relationship with 2 year moving average? So, we will see some very simple uh, moving averages and see what has been Nifty and the correlation along with it. So, if we see the last 4 or 5 years of data, you'll find that Nifty has very almost perfectly taken support at 2 year moving average. So, this white line that you see is a 2 year moving average. You can see here 24 months is the chosen period for this moving average. And this is almost the fourth time that we have taken support on it and starting to move up. In the past, this was this period that I was just showing you. In the past, while 2 year moving average has not really provided precise support, but you can see here that almost there on many occasions, barring the big COVID fall and the big 2008 crisis, uh, and the sort of crisis or the sideways movement in 2012. Other than that, you would say that reasonably markets have not really broken the 2 year moving average. So statistically, how does it look in terms of where Nifty has traveled in 6 months, 1 year, 2 year, 3 year after taking support at 2 year moving average in the last 25 years? So this entire 25-year period is available. All these support points of the 2 year moving average, and you see that on average, out of all these situations, whether it was from 2003, 4, 9, 12, 13 and so on, you can see that 6 months later, out of every time, moving average of 2 years has been taken support at. You were up 17% within 6 months. You were up 25% within 1 year, and you were up 21% CAGR within 2 years and 19% within 3 years. That is the average. Of course, the specific data points could be a bit divergent. So when we see uh, the let's say a year later, while the average is 25%, we've had the minimum at 1 year also, but maximum at 50 years, 50%. 2 years later, average is 21% with minimum at 6%, max at 44%, and 3 years later, CAGR has been as low as 3% and max at 45%. So 1 year forward basically is positive in 11 out of 11 cases. So this is actually showing a strong probability of gains 1 year after similar past setups. So if right now in the last 3 months we have taken, let's go back to the chart uh, right here. So if we have taken April as sort of the support, March actually, where the support was taken, and then there was a retest of that sort which did not stick there. So if we see that, we've always sort of come back up from that test. uh, 11 on 11 cases you've made gains in the last 25 odd years. uh, 6 months you made 10 gains out of 11. So the only negative was in June 16 for 1%. 2 and 3 year forward CAGR has been very promising, with one instance of weak phase each. And there has been some turnaround phases where September 12 and August 2019, where you had a 3 year CAGR at 12% and 2 year at 25% for August 19. So the idea here, of course, is remaining invested. Of course, the the narrative that comes around, in terms of there is war, there's going to be an impact on the economy, and the fact that one should get out and come in later, I think that has not worked very well for most people, and I certainly don't recommend that. In Nifty, if we see from the bottom, is already up 13% after taking support in Feb 2025. Strong forward performance is, of course, not guaranteed outcome at every instance, but as per history, there has been a high probability. So that is sort of the mute point, that the chart may look like, as if it may do this, but it may do that as well. So you really can't say, but what you can do is keep your uh, basically your approach towards the market not change because of the narrative around you. The markets can also do what is shown in this chart. It's not really an impossible thing to happen. So without having that kind of an optimism in the market, it is very difficult to invest. uh, as you would have known, if you are, let's say, not doing non-discretionary methods, and if you are having discretionary methods, then valuation in the market is continuously going up, and at very high valuations conventional investing is very difficult to do. How do you justify you're staying in those particular stocks? So having a structure around your investing is very important, because it removes that human touch, that human uh, you will not blame yourself if things are going wrong, to the extent that it will not make you nervous, because there are no set rules. Once you move into a structured strategy, then you are following some rule based system. And yes, there may be ups, there may be downs, that is fine, but at least you are assured that if there is a huge run, for instance, the adaptive strategy that you have will follow the rules and make sure that you get some winners. If there is a huge drop, you know that the strategy is going to eliminate losers and go to cash or go into other stocks. So following a systematic way of investing actually keeps you mentally very free, because the conventional way keeps you very tense. What if I'm not able to replicate what I did in the last 4 years? What if I'm not able to pick winners going forward? Should I sell? Should I buy? It's just so much of noise that continues to happen in front of you. So so this is where so you can draw some confidence. I know statistics of the past cannot predict anything in the future, but this is where you draw confidence. This is where you try to stay optimistic and stay the path of your strategy, and go wherever the market goes. You just follow the market, how the way it is going forward. So let me know in the comments, what are your thoughts on this discretionary versus non-discretionary debate, and where do you think Nifty could be in the next 3 years? That is up for debate. Thank you so much for watching, and do like and share these videos and subscribe to the channel. Thanks. Bye.